The next section we're going to do is get, hopefully, the three of them either agreeing or disagreeing on each one's presentation. That's why the buns are soft. They're not hard. Everything you notice at the breakfast table was rather soft. Coffee was lukewarm. So I don't fear disagreeing with each other, please. Toronto is now going through a Tory, Chung, and Ford debate, so I don't anticipate this will get anywhere near that kind of a debate. This is the mayoral candidates up here. Anyway, I'm going to critique what I think I heard. I heard from Peter there's pent-up demand. I've heard from David that there's a challenge for sustainable disposable income. And I've heard from Dan that unemployment has not recovered, which I guess gets connected with disposable income going forward. So let's start off with a little bit of a comment amongst the three of you as to which one of those three issues is going to either cause the economy. What is your biggest fear of our recovery continuing to be sustainable, even if it is only a 2.5 GDP?
You've been the longest since you spoke.
I'll jump in. Wonderful presentations from both of you. Very informative, I thought. Peter's absolutely right about unemployment being a lagging indicator. That's true. But it's been lagging for 6 years. We've been looking at leading indicators for the last 6 years, all pointing up, and that's why we've had positive growth for that long. Leading indicators don't necessarily tell you how strong future growth is going to be. My favorite leading indicator is what we call the yield spread, and it's been positive for 6 years or something like that. So we're very confident that there will be a continued recovery. We're still confident about that. But still, we're 5 to 10 million jobs short, and that's why we think the growth rate that we're confident is going to happen, the growth rate is going to be weak, as it's been ever since the recession, the recovery started. Recovery started 20 quarters ago. As I say, if you look at historical data during a recovery, you would normally see growth rates of about 4.5%. There's been 1 quarter out of 20 that has been even at that average. We even had 2 negative quarters. So it's been a very slow recovery, and we expect to continue to see that, despite the fact that unemployment is a lagging indicator. We just don't have enough people at work to boost the economy to growth rates we'd really like to see.
David, any thought?
Sure. Unfortunately, this comes out of my presentation. Following this one, I don't really have a lot of disagreement with Dan. I actually, every year at this time, I usually come across Peter's presentations, and I do turn more optimistic. I think that's a fair reflection at this time of year. You are usually optimistic. Usually this time of year I'm optimistic too, but this year we seem to be going in a different direction from our perspective. When I think about employment, again, employment is a lagging indicator. But I also pay a close attention not just to where employment is, but trends. And something like the trend, the employment to population ratio. It's not that we're waiting for it to recover, it's that it's been sliding for the past 2 years. And so that tells me that there is something going on in the Canadian economy, that we're not getting jobs. And it's not just we're waiting 6 months and then job growth will take off. And so I am of that perspective that when you see a trend developing, respect the trend and don't necessarily go against that. And so while I do agree that employment is a bit of a lagging indicator, what it tells me is that the Canadian economy hasn't been doing all that well. And so I'm cautious heading into next year. And the other thing that Peter made a good point. There's that old adage, 7 years of feast, 7 years of famine. So according to his forecast, we should only have 1 more year of famine in the United States, and then we can return to positive growth, because we had basically a 6-year boom, basically, and then now we're going into the famine period. But the way we like to focus on it is, and this actually sort of leads into one of the reasons why we still do have positive growth in the United States. We had a balance sheet recession. And so basically what we saw was that the balance sheet, especially in the household sector, became imbalanced. There had to be a correction. It took an extremely long period of time, and now we think that that balance sheet recession is, to an extent, beginning to lose its grip. I agree with Peter on terms of the rebound in consumer confidence. One of the charts that I like to use in my presentation, now I wish I'd brought that presentation, is if you look at Canadian consumer confidence and US consumer confidence, what you basically see is that US consumer confidence has crossed over Canadian consumer confidence for the first time basically since the recession. That's actually one of the reasons when we build into our forecast, even though we're not necessarily optimistic about the US, we have a higher growth rate in the United States than in Canada. We do agree in the idea that the consumer is coming back. We just disagree with the veracity at which the US consumer is coming back. We think that the household balance sheet correction does mean that I think Americans are going to be less likely to borrow as aggressively as they did in the past. I think the financial sector will be less likely to lend than they were in the past. And that as a result of that, and then also we'll have sluggish income growth. And so we still have concerns more than Peter does with regard to what's going on in the US. In Canada, I've got the other side of it. Whereas if you look at the US balance sheet before they went into their recession and the housing crash, I don't think we necessarily have to have a housing crash in Canada, but if you look at the household balance sheet, it does tell me that consumers are extremely overextended and that the consumer has to go through a period, not necessarily of outright correction in household debts, but certainly through a period of austerity. And we haven't seen that yet. And that sort of forms the key thesis to our idea that the US is coming back, but we think it'll be relatively sluggish, and Canada is basically going to underperform the US over the next couple of years.
Thank you.
Well,
Peter?
I did a disservice, I guess. I agree more with David than you might think with respect to the Canadian economy. I just focused on the US economy because I was looking at, okay, what's driving things going forward? But I completely agree that we have weak fundamentals in Canada. We have an overbuilt housing market. We have a heavily indebted consumer. And so we have gone domestically in the wrong direction from the United States. And when you look at the amount of fiscal consolidation that still needs to happen at the provincial level in Canada, government sector is not going to be a driver of growth either. So we're aligned. What I'm trying to make a case for is, is Canada just lucky again, as it was when the crash happened? We lost 25% of our trade in 2009, just like that. And we're a trading economy, and normally that's enough to T-bone the rest of the economy. We got this remarkable thing that happened. For the first time I can ever remember, we had a domestic economy that bailed us out. But we did that on a mountain of debt. We have overextended ourselves. But just as that sector is losing steam, we see the export sector coming back. Now, if you want to look at how this US growth is translating into something north of the border here, have a look at our merchandise trade series. I don't think it's, as David said, we've got a flash inside of a series that we can put no confidence in, because when you look at how that growth is distributed across industries in real terms, take the inflation movements out of it, across industries and across provinces in Canada, there are very few that are being left behind by this thing. Well, that looks to me like a broad-based groundswell. And if it's anchored in a US economy that has pent-up demand, that has the ability to sustain this growth going forward, then I'm not as worried about that. Now, I haven't been optimistic year after year, because as we tracked what the world economy was doing over that period of time, we thought, stimulus kicked us back into gear. But the way that stimulus comes into an economy is it comes in with a flash, gets up to peak spending, and you continue at that spending level. But hold on, if you're spending aggressive amounts of money this quarter just to replace the aggressive amounts of money that you spent last quarter, you get no growth out of that. And so we looked at a quasi-recovery, and then we said, we're going to have a few years of flat here. So, me being sort of perpetually optimistic at this time of year isn't quite the record that we had. We are optimistic now because I can be dismal with the rest of them, believe me. Just check my record. But I believe that you've got to choose those moments when the indicators are telling you, okay, here we go. Back in 2008, I was a $70 oil guy when Jeff Rubin was trying to sell $200 oil to everybody. So I can be gloomy, okay? But this time around, the way that we see those indicators coming up is that way. I have to just say one thing about employment. We can hand-wring about how bad the employment situation is now. But let me just rewind back to, the latter stages of the last long growth cycle period, when we and the Americans and the Europeans were saying, well, we've gone below what economists would call the non-accelerating inflation rate of unemployment, NAIRU. We've gone below that, and we don't see excessive inflation happening inside of the economy. And now we're saying that we've got this incredible structural problem with employment. Like, come on, what side of the fence are we on here? How could we just 5 years ago have said, well, we're breaking new territory because we can have abnormally low unemployment rates with no inflation or no significant uptick in inflation, and now something has changed so radically, structurally, that we're never going to see that again? I don't buy it. I just think this is an extended cycle. The cycle is still there, it's just exaggerated.
Excellent.